There was a time, back in the year 2000, when a company that had never made a single dollar in profit could be worth billions one day and then be completely worthless just a few months later. This is the story of the dot-com bubble. But listen, this isn't just a history lesson. It's a massive warning about the economic forces that are, believe me, very much at play today. So let's get into how it all happened and what it really means for all of us right now. To really wrap your head around the sheer scale of what happened, you have to start with this number: $5 trillion. That is how much money, how much market value was created and then just poof, completely vaporized in less than 2 years. That's like the entire economy of a country like Japan just vanishing into thin air. It's staggering. And this is the part that should really make you sit up and pay attention. The way the collapse happened, the patterns of belief, the hype, the investor behavior that led to it, well, guess what? It never went away. Sure, the tech has changed, the company names are different, but the human psychology behind it all, it's playing out in our markets in almost the exact same way. So that leads us to the big central mystery of the dot-com bubble, right? How did this happen? Why didn't anyone, especially the smartest people on Wall Street, stop it, even when they could see the train wreck coming? The answer isn't as simple as just greed, and that's what makes this story so unbelievably fascinating, and frankly, so dangerous. A bubble of this size doesn't just pop up out of nowhere. It's not a random event. It's more like a recipe where you need specific ingredients to come together at just the right time to create a perfect storm. In this case, there were 3 of these massive forces that all hit at once. Okay, so here's how these 3 things fed off each other. First, ingredient 1, a world-changing technology. The World Wide Web suddenly became available to everyone. It was revolutionary. Second, ingredient 2, a flood of easy money. The government deregulated the telecom industry, and the Fed kept interest rates low, making cash incredibly cheap to borrow and invest. And then, the third and most powerful ingredient of all, a story. A really compelling story about a new economy, where the old boring rules, like needing to make a profit, just didn't matter anymore. All right, so you've got the ingredients. Now let's watch how this thing cooks up into a full-blown, absolutely wild mania. This is the part of the story where logic just gets tossed out the window, and the old-fashioned way of valuing a company, yeah, that went with it. You can pretty much pinpoint the exact day the market's brain snapped. August 9th, 1995. A company called Netscape, which made a web browser they mostly gave away for free and had 0 profits to show for it, went public. Instantly, it was valued at almost $3 billion. Right there, the link between what a company was worth and what it actually earned was just severed. And that Netscape IPO, it wasn't a one-off thing. It was the starting gun for the race. Just look at this timeline. You can see the explosion. The NASDAQ index, which is full of all these tech companies, went from under 1,000 points in 95 to over 5,000 just 5 years later. And along the way, you had these absolutely bonkers events, like a website called theglobe.com, which was losing millions, seeing its stock price jump 606% on its very first day of trading. The growth wasn't just fast, it was vertical. This comparison really highlights just how absurd things got. On one hand, you had companies like Pets.com. They were famous for their sock puppet mascot, and their business model was, I kid you not, to sell heavy bags of dog food online for less than they paid for them. They were losing money on every single sale. They burned millions on Super Bowl ads, but their value was based on eyeballs, how many people visited their site, and pure fear of missing out. Meanwhile, boring, old, profitable companies were trading for a tiny fraction of these dot-coms. It was completely upside down. And this is where the story takes a bit of a darker turn. The people who were supposed to be the grown-ups in the room, the Wall Street analysts guiding regular investors, well, they were in a huge conflict of interest. We later found out from internal emails that these analysts were publicly slapping buy ratings on stocks that, in private, they were calling junk and crap. Why? All to help their own banks win the very profitable business of taking these dot-coms public. A party like this doesn't just end. It slams into a wall, and that wall is usually reality. In the case of the dot-com bubble, the wall was made of something very simple: basic math. So here's the fatal flaw, the mathematical impossibility at the heart of the bubble. The market was valuing, say, dozens of different online pet stores as if each one of them was going to become the single dominant player in the entire pet supply industry. When you added up the Wall Street valuations of all those companies, they were worth more than the entire pet industry itself. It was a mathematical certainty that most of them had to fail. There was no other way. They couldn't all win the same prize. And once that belief finally shattered, the collapse wasn't a single event. It was a domino effect that rippled through the entire economy. First, the most obvious ones, the companies with no profits, they just ran out of cash and disappeared. But then even the real companies, the survivors like Amazon, saw their stocks get hammered, falling over 90%. That panic dragged down the whole tech sector, then the companies that built the physical internet went bankrupt, and finally, the venture capital money that fueled the whole thing just dried up. And this chart shows you the brutal aftermath. From its highest point in March of 2000 to the bottom in October 2002, the NASDAQ index lost a gut-wrenching 78% of its value. Think about that. 2 straight years of relentless selling that wiped out trillions and trillions of dollars of wealth. Okay, so why dig all this up? Why does a 20-year-old story matter so much today? Because the echo of 1999, the patterns, the language, the hype, it came back. And in 2021, it wasn't an echo, it was a deafening roar. It was an almost perfect replay. Just look at this. It's almost spooky. The guiding narrative was exactly the same. This time is different. The flawed metrics were the same. They just got a new name. Eyeballs became community or active users. The hot assets, unprofitable tech stocks, just like before, but this time with things like SPACs and crypto thrown into the mix. And the fuel for the fire? Identical. Rock bottom interest rates and a massive, powerful wave of FOMO. So this gives us a pretty reliable 5-point checklist for spotting a bubble in the wild. When you see companies that don't make money being valued higher than ones that do, when you see people investing purely out of FOMO, when the main argument you hear is, this time is different, and anyone who disagrees is called old-fashioned or worse, you're probably in a bubble. It's a pattern that repeats over and over again. So what do we do with all this? What's the big takeaway? Well, the good news is that this painful history gives us some really clear, really simple lessons for how to navigate the markets and, hopefully, survive the next bubble, because there will be a next one. Here are the 3 big ones that have stood the test of time. First, and this is the most important, fundamentals always matter in the long run. It doesn't matter how cool the tech is, a business has to eventually make more money than it spends. It's like financial gravity. Second, understand incentives. Everybody from the founders to the bankers to the media has a reason to keep the hype train rolling. You have to be skeptical of the crowd. And third, regulation is always playing catch-up. You can't rely on the government to protect you from the latest, riskiest new thing. You have to be your own first line of defense. And that really brings us to the final, most important question. This isn't about what you would have done back in 1999. It's about right now. Knowing what you know now about how these cycles work, about how these manias form and collapse, what are you going to do differently in your own financial life? Look, if this story changed the way you think about the markets, even a little bit, then I'd really encourage you to subscribe. Every single week, we dive deep into stories just like this, major financial events from all over the world, to help you really understand the powerful forces that shape our economy and our lives. So please, go ahead and subscribe to the DreamSoft Technologies Canada channel for more explainers like this one. You can join the conversation with us and other viewers in our WhatsApp channel family. And of course, if you got value out of this, a like and a comment really helps us out. If you want to take your learning even further, check out the link in the description. We've got free online courses on finance management and a whole lot more. Thanks so much for watching.